we all know that it's a bear market right now. The S&P 500 is down 19.28% so far in 2022. This is year to date. And then the NASDAQ is down 30.88% so far year to date. So has it been a great time to invest in the stock market? This year, it has not been a good time to invest in the stock market. However, you know what? You may actually just be making a huge mistake if you're not. Let me explain. But first, hey, my name's Robbie. I make videos on ETFs, stock market investing, commentary about the stock market, personal finance, and today I do have a cold. I'm not on my A game, I'm just gonna admit that, but I'm gonna try to get this video out to you because I think it's a good one and I think you're gonna wanna know about this. So why might you be making a mistake right now by not investing in the stock market when we know the market is down so much? I know a lot of you are watching this video and you've actually had pretty large declines in your balances, right? Maybe you invested more in like the tech sector and you actually have worse returns than this, or maybe you're more conservative and you even had bonds, but your bonds are actually still down a lot too. So anywhere you hid right now in this market, it's been a really rough time. In this time period, 2022, it's been an abysmal year to be investing, but that doesn't mean that right now is not an amazing time to be investing. And I'm gonna explain this by showing you the JP Morgan Guide to the Markets, which they put out quarterly, which is a really great report. I know for those of you who are kind of newer to this might look a little intimidating. I am going to make sure that you understand this whole thing by the end of it. So let's start with the basic concept of this, which is measuring how much you could have made from the bottom of the market up to the previous highs. This is a chart of the S&P 500's return over around a year. And what you can see here is back in January of 2022, this was the top of the market. That was the peak of the market. And since then, of course, we're down quite a bit. So what we're doing in this, though, is we're measuring. What if you invest right now and we get back to the peak of the market? So for example, when JP Morgan ran that report, the market was a little bit lower, kind of around here. I'm not sure the exact number, but let's call it, 33%-ish, right? And so what they're saying is, if you had invested and it grew to the top of the market again, this peak, how much would you have made in return? They're also annualizing this to show you how much you could have made annually over different time periods. So let's take a look at this thing. So JP Morgan is calculating here is a 35.7% return if you invested and then you held your money over a 1 year period and then it got to those peaks. If you hold it over a year and it comes back to the peak, of course, that's your annualized return. So 35.7% is an annual return if we get back to the peaks within 1 year from when they ran that report. What's really great about this report, it's gonna show us annually if it doesn't take a year to get back to those peaks, right? Let's be realistic. What if it takes longer? What if it takes 2 years to get back to the peaks, right? If it does, you'll have a 17.6% annual return over that time period. So that's an amazing return. So right now, let's say you invested and we get back to the peaks in 2 years, 17.6%, that's an amazing return. What if you're a little more pessimistic about the market? What if it lasts 3 years? Well, if it does, it's a 12.1% return. If you annualize that over a 3-year period, and then, okay, let's say a 4-year period, let's get even more pessimistic. 9.4% still over a 4-year period. I mean, people, these are great returns still. 9.4% to get back to the peak of the market over 4 years, that's a great return. Let's be ultra pessimistic here. 5-year return. 7.9%. Where are you going to get 7.9% right now? It'll beat inflation for sure. You're not getting it in your bank. You're not getting it in bonds. You're not getting it anywhere except maybe potentially in the stock market. This is new money that goes into the market. If you're dollar cost averaging into the market, you want this to happen. The lower the market goes, the more your return is going to be over time, over a long period of time. This is actually good news for some people. Now, of course, if you're getting close to retirement, this isn't great news, but if you're younger, if you're looking into investing over like 30 years, this is great. And so if I'm being selfish here, I'm saying I'm actually happy right now that the market is down in terms of my ability to be investing more money into the market right now at lower prices because I'm going to get great returns. What are the averages of the returns? Okay, let's talk about that. On the left side, we have bull markets. On the right side, we have bear markets. So this is when the bull market began. So the bull market date that the bull market actually started. Then we have the bull market return over that date, and then how long the duration in months of that bull market. Now, the average of all bull markets, if you take them all together, the average was 162% return over the average bull market. And the average amount of time that a bull market lasts for is 51 months. So let's say almost 4.5 years is the average for a bull market, okay? So That's a great return. 162% over a 4-year period of time. I mean, that's great. Now, next question. What about the bear markets? Now remember, by knowing the averages, maybe it's going to help us at least assume that we know what lies in store for us, potentially, right? So let's take the average bear market. We have the left side here. This is when the market peaked. This is the date. We have the return over that time period of the duration, how many months it lasted for. The average was negative 41% for the average bear market. So remember, right now I showed you that the S&P 500, it's down 19 something percent. The most it got to was just a little bit over 20% down. So we are not even close to the averages. Now, what's that mean? Well, maybe we could be done with the bear market. It's possible, but it's also possible we have a little bit further to go. Now, people, I don't know when the bear market's going to end. Honestly, I have no idea. I just know, okay, let's take a look at averages, and it might go further down. I don't care about that, though. Why don't I care? Because the average the average bear market is 20 months, okay? 20 months. We're about 10 months into the average bear market right now. We're about 10 months into the current bear market. And if the average is 20, we're halfway there right now. So you might be saying to yourself, Robbie, why would you be still wanting to invest when it's possible that the market can still go down 40 to 41% when we're only down 19 something percent? And my answer is because I'll dollar cost average into this thing, and I will lower my average cost basis as it goes down. Now, I know that sounded like an alien language to some people who are kind of newer starting off with this whole thing, so let me explain. Let's say as this market's been going down, I'm going to throw a downtrend channel on here just so you can visually see this better. This is the S&P 500. It's going down, okay? Let's say I invest at the top. Boom. Okay, well, I don't like that because now I bought at the top. The top here, let's say the price is $4,800, okay? Let's say I bought the index, it cost me $4,800. Let's say I wait a month, okay? Now I buy at another price. Now I'm buying at $4,396. Well, the average of those two is actually lower than the price I paid, right? Because I bought one a little bit higher and one a little lower. So now my average is a bit lower. And let's say I keep doing that. Let's say I keep doing it, let's say monthly. And so you see all these green arrows, right? These are all times that I would have bought into the market, right? These are times I would have purchased into the market. Well, are they all below the top? Well, yeah, right? They are. So I would undoubtedly have a lower cost basis as I was going down, right? The amount of money that my average amount that I invest into this market is continuing to go down as the market goes down. This is a good thing. Let me show you this back in 2008, the Great Recession, one of the worst time periods to be investing in the stock market, right? Okay, let's say I invested here, 1,500. Let's say 1,500 is my cost basis. I go in and I buy. Same thing, I'm gonna buy as it goes down. So check this out. I'm buying on the way down. I did not hit the bottom. I did not make it to the bottom. I didn't buy in at the bottom. All I did was I bought over time as it was going down. My cost basis is gonna be much less than that first purchase price. This is the beauty of dollar cost averaging into a down market. And to show you what happens here, well, let's take a zoom out, okay? What happens when we zoom out? Does this thing look better or worse? So, okay, boom, look at this. 2017 over here, 2017. Okay, am I happy that I bought on the way down here and lowered my cost basis? Yeah, I am. Why would it be any different this time? So the simple answer I wanted to get across in this video is, depending on how long the next bear market is, we might go a little further down. Maybe we're going to get to 41% down. Maybe it's going to be 20 months, being that we're halfway there. And maybe in that time period, we can average down. And if that doesn't happen and we're already at the bottom right now, well, we're going to have good returns from here on out. Meaning that, let's say it takes 3 years to get back to the top, the peak of the market. Well, if it does, you're going to probably have, well, it's a little higher now where we're buying in, but you know, we might be buying in and let's say having a 10% return average over the next 3 years. That's a great return and something we should all be proud of. So anyway, support the channel, got some affiliate links below, hit that like button, subscribe, and see you next time.